Welcome to the Deep Dive. Today we're really digging into the Q3 earnings from Hasbro. And it's quite a story, isn't it? A real divergence between different parts of the business.
It really is, yeah. We're looking at the Q3 2025 results. They dropped pre-market October 23rd. And it was, well, fascinating. You had this powerful internal performance, especially from their IP side, butting right up against, ongoing macro issues in retail.
Right. So our goal here is to kind of cut through the usual earnings call jargon, get beyond the press release, and really give you the key takeaways. What's driving this strategic shift, this transformation into an IP giant?
Okay, let's start with the top line numbers. A solid beat, really, on both revenue and earnings. And the market noticed stock closed up, 3.7%?
Yeah, decent pop.
So revenue was $1.39 billion. That was comfortably ahead of the $1.34 billion the street was looking for. And that's an 8% jump year over year.
And the adjusted EPS. That landed at $1.68, also beating expectations. But we should probably mention that EPS figure was actually down 3% compared to last year.
Right, and they flagged that, mostly down to things like foreign exchange rates and higher taxes. If you strip those out, though, the underlying business operationally looked pretty strong.
And that strength, as you said, wasn't spread evenly.
Yeah.
The big story here is that divergence. Wizards of the Coast and digital gaming. I mean, that segment was just on fire.
Absolutely, the engine. Massive 42% year-over-year revenue growth there, 42%.
Wow. And it's that kind of number, that 2%, that lets management confidently raise the guidance for the whole year, right?
Exactly. They bumped up the total revenue growth forecast to high single digits. That was up from mid-single digits before.
Right.
And adjusted EBITDA guidance, now looking at $1.24 billion to $1.26 billion. That's a pretty loud signal of confidence.
It really is.
Yeah.
And it all seems to track back to the IP, especially within WOTC.
Yeah, definitely. Magic, The Gathering, MTG, that was the powerhouse. Revenue there soared 55%. 55, and it really proves that their universes beyond strategy is working.
Right, that's the one where they bring in outside IPs like Spider-Man, Final Fantasy.
Yeah. Precisely. And it pulls in new players, new collectors. Management talked about record engagement, record event attendance, even search trends are way up. It's turning MTG into this kind of cultural hub, not just a card game.
And the pipeline for that looks pretty stacked, too.
Oh yeah, zero signs of slowing down. For 2026, they've already confirmed Teenage Mutant Ninja Turtles, The Hobbit, Star Trek, and Marvel Superheroes. Big names. They even hinted one of the next sets might challenge the Final Fantasy launch, which was a record breaker.
Wait, TMNT and Marvel Superheroes, that's huge. They must be locking these deals down years ahead. Is there a risk, though, that they saturate the market with too many crossovers?
That's a fair question. But they seem pretty strategic about which IPs they pick, making sure they kind of fit the MTG vibe. And, WOTC isn't only MTG. D&D is pulling its weight, too.
Oh, right. Dungeons and Dragons.
Yeah, the 2024 core rulebook refreshes Monster Manual and so on. Had the best launch ever for D&D books. Strong core IP performance there.
And they're pushing digital, too, right?
Yeah.
D&D Beyond.
Definitely. The new virtual tabletop on D&D Beyond, weekly traffic jumped almost 50% since it launched in September. Plus, you've got their mobile games like Monopoly Go and the new Sorry World doing really well on the charts, leveraging those old brands digitally.
It's interesting, though. WOTC is driving the growth, heavily digital, but it also seems to carry this significant future accounting thing. You mentioned the Exodus game.
Yeah, exactly. That's the paradox. They gave some important details on Exodus, their big upcoming sci-fi RPG. We should get more updates in December.
Okay, let's unpack that. Because the investment sounds pretty significant.
It is. The development budget is somewhere between $100 million and $250 million. That's a major, major bet on one game.
Oh,
But here's the crucial bit for investors, the accounting detail. 65% of that development cost gets depreciated through cost of goods sold, COGS, all in the single quarter the game launches. And this is key. They specifically said it will not be added back to adjusted EBITDA.
Why is not adding it back so important? Don't companies usually try to smooth things out by adding back big one-off costs?
They often do. But by not adding it back, Hasbro is essentially guaranteeing a huge swing in reported numbers for that quarter. Even if Exodus is a smash hit, sells millions. That accounting charge, somewhere between maybe $65 million and $162.5 million, is going to hit net income and EBITDA hard just for that one quarter. It creates this expectation of a temporary dip, regardless of success.
So WTC, growth engine, but also volatility engine. Okay. Let's pivot then to the other side of the coin.
Yeah.
Consumer products. Totally different story there.
Completely different. Revenue down 7% year over year, landing at $797 million. And you saw margin compression, too, down to 11.2% from 15.1% last year.
Ouch. And that's where the tariffs and unfavorable product mix really bite.
Exactly. That's where you feel the macro friction most acutely.
Now, management tried to frame that Q3 dip as mostly about timing, retailer orders shifting into Q4. But I mean, a 7% drop and margins getting squeezed like that, are we sure it's just timing? Or is there something deeper going on with traditional toys?
Well, that's the million-dollar question, isn't it? That's what the market's wrestling with. Management pushed back, pointing to some positive signs like point of sale, POS, data accelerating over the last, say, 7 or 8 weeks.
Suggesting the shelf resets are starting to work.
Potentially. And maybe more importantly, retail inventory levels were down mid to high teens, down coming into Q4. That should force retailers to place restocking orders for the holidays.
Okay, low inventory is definitely a positive signal for future orders. But even if Q4 bounces back, the guidance for the full year for CP is still a decline, mid-single digits. Which brings us back to those tariffs they're trying to manage.
Right. They basically put a number on it. A $60 million hit for the full year 2025 is their working assumption. And Q4 is actually expected to bear a bigger chunk of that than Q3 did, which was around $20 million. So yeah, they needed a serious tariff remediation playbook, as they called it.
And the main play there is diversifying the supply chain, moving away from China.
Yeah, it's ambitious. The goal is, by the end of 2026, no single country outside the U.S. makes up more than a third of their supply. A significant shift, using more domestic capacity, too.
And they're cutting costs elsewhere.
Oh, yeah. They're sticking to that plan to find $1 billion in cost savings by 2027. That discipline, plus the WOTC engine, that's what's kind of holding the whole thing steady against the retail headwinds.
So looking forward, the market seems to be betting that this IP pivot continues to work. The good quarter, the raised guidance, it's building conviction, hence the price target bumps we saw.
Absolutely. And for the CP segment to really turn around, that 2026 entertainment slate is just crucial. You've got Toy Story 5, the new Star Wars movie with Mando and Grogu.
Oh, and the Avengers return with Robert Downey Jr. back, but as Dr. Doom.
Exactly. That kind of massive entertainment lineup is really what it takes to potentially reverse the trend in traditional toys these days.
Okay, one last piece. Balance sheet health. Leverage targets.
They expect to hit their goal of 2.5 times leverage by the end of this year. Hitting that gives them breathing room, financial flexibility for 2026, maybe more investment, like funding Exodus or maybe paying down more debt.
So the big picture, IP is winning the war, even if retail is still a tough battleground.
That sums it up pretty well.
All right. Now for the part of the deep dive where we float a potentially crazy but maybe plausible trade idea based on everything we've just discussed.
And let's be crystal clear. This is just a thought experiment looking at the market dynamics. It is absolutely not financial advice or a recommendation, just exploring the what ifs.
Okay, so given the strong WOTC momentum, but also knowing that huge Exodus depreciation hit is coming in 2026, that guaranteed accounting quirk.
Right.
We're thinking about a trade built around volatility, a long gamma play.
Right. The core idea is to bet on a big swing in the stock price. You could look at buying long-dated call options, ones that expire well after the likely Exodus launch window, and maybe pair those with some near-term out-of-the-money puts.
Why the puts?
Sort of a hedge against any near-term shocks, like a really bad holiday season for toys or unexpected tariff news, before the Exodus story fully plays out.
So the main bet is on that massive volatility spike when Exodus launches. If the game's a hit.
If it's a hit, the revenue and cash flow could be enormous, totally overshadowing that temporary accounting hit from the depreciation. The stock could surge, making those long calls very valuable.
And if it flops?
If it flops, that write-down still hits, and it hits hard, potentially pushing the stock down. But the underlying strength of MTG and D&D, that core WOTC business, provides something of a floor, maybe limiting the downside compared to the potential upside if the game succeeds. The puts offer some protection there too. It's really a bet on the asymmetry, leveraging the upside potential while acknowledging the known timed accounting impact.
A bet that the strategic success eventually trumps the short-term accounting noise.
Interesting. Okay, so summing up. A strong quarter overall, really highlighted by that IP power and the execution on the strategic shift. Yep.
Clean beat, raised guidance, and WATC is clearly the indispensable engine right now.
But there's still caution around retail. Those tariff headwinds are still blowing.
For sure. Management's positioned the company for growth, but it's less tied to traditional retail now. The big question going forward is, can WOTC keep growing fast enough to offset the drag from consumer products, at least until that huge 2026 content slate arrives.
That seems to be the crux of it. Well, thanks for joining us for this deep dive. Now, thinking about everything we covered, what element really jumps out at you? Is it the sheer scale of the Exodus bet and its weird accounting, the relentless Universes Beyond push, or maybe how fast they're trying to shift that supply chain?